Hey everyone, welcome back to Corporate Dakota. Today, AutoZone Incorporated just filed their quarterly report for May 2026, and I'm seeing some interesting trends that might surprise you in this auto parts giant. Quick note, this is not financial advice, just my take on public filings for educational purposes. AutoZone sales are up across the board, but one number in their cost of sales is really making me pay attention, and it could signal a shift in how they manage their suppliers. So AutoZone released their latest quarterly report today, giving us a peek under the hood of their business for the period ending May 9, 2026. We are looking at their financial heartbeat, the numbers that really tell the story of where the company is and where it might be going. First up, let's glance at their balance sheet. This is like a snapshot of everything the company owns and everything it owes at a specific moment. For assets, total assets stand at a hefty $20.9 billion as of May 2026. That is a solid jump from $19.3 billion in August 2025. What is driving this? Well, merchandise inventories alone are sitting at over $7.5 billion, showing they are stocking up big time. Property and equipment also saw a healthy increase, reaching nearly $7.8 billion after accounting for depreciation, suggesting they are investing in their physical stores and infrastructure. On the flip side, liabilities are also significant, totaling $10 billion in current liabilities and another $9 billion in long-term debt. Essentially, they are carrying a lot of debt, which is common for a large corporation, but it is always something to keep an eye on. Now for the income statement, which shows how much money they made and spent over a period. For the 12 weeks ending May 9, 2026, net sales hit $4.8 billion. That is a strong 8.4% increase compared to the same period last year. They managed to grow their gross profit to $2.5 billion. But here is where it gets interesting. Gross profit as a percentage of sales dipped slightly to 52.2% from 52.7%. The report mentions a net non-cash LIFO impact as a driver for this. LIFO stands for last in, first out, an accounting method for inventory, a non. Cash LIFO impact means it affects their reported profit without actually spending cash right now, but it can sometimes mask the underlying profitability if not understood. The report also highlights that operating expenses as a percentage of sales actually improved slightly, which is good news, meaning they are not letting their overhead grow faster than their sales. Net income for these 12 weeks was $641.5 million, up from $608.4 million in the prior year. Earnings per S-Hair also saw a nice bump. Moving to the cash flow statement, this is crucial because it shows the actual cash moving in and out of the business. For the 36 weeks ending May 9, 2026, they generated a massive $2.1 billion in cash from operating activities. This is the lifeblood of the company. However, their investing activities used over $1 billion in cash. A big chunk of that, almost $1 billion, went into capital expenditures. This means they are investing heavily in things like new stores and expanding their hub and mega hub store projects. They opened 199 net new stores in this period, which is quite aggressive expansion. Financing activities, where they managed debt and equity, used over $1.1 billion. This was largely due to significant stock repurchases totaling $1.3 billion. It seems they are prioritizing returning cash to shareholders by buying back their own stock. Now, let's look at the stockholders' deficit. This section shows the company's equity. As of May 9, 2026, the company has a retained deficit of nearly $3.8 billion. This might sound alarming, but it is quite common for mature, profitable companies that have a long history of returning value to shareholders through share buybacks and dividends. Essentially, they have paid out more in dividends and buybacks than they have accumulated in retained earnings over their entire history. Their additional paid-in capital is substantial at almost $2 billion, which represents the money shareholders have paid for stock above its par value. The company is preparing these statements in accordance with US Generally Accepted Accounting Principles, or GAAP. They want to make sure everything is presented fairly. They also mention that their business is seasonal, with sales typically peaking in the warmer months and dipping in winter. This is pretty standard for the auto parts industry. Here is a detail that caught my eye. Their inventory is valued using the last in, first out, or LIFO method for domestic stock. This method can sometimes make reported profits look lower in periods of rising prices, which could be happening now due to inflation. The report notes a LIFO credit reserve balance of $260 million. This is a significant amount and indicates that they are potentially deferring a large tax liability by using this inventory accounting method. It is a way to manage their tax burden, but it also means that if inventory costs were to fall, their reported profits could be impacted. AutoZone invests in tax credit funds, which they classify as variable interest entities, or VIEs. They have determined they are not the primary beneficiary of these entities, meaning they do not control them enough to consolidate them onto their main financial statements. These investments are accounted for using the equity method, and their maximum exposure is limited to their net investment, which was about $71 million. This is a relatively small amount compared to their overall business. This section discusses how they value certain assets and liabilities. They use a 3-level hierarchy, with level 1 being the most reliable market prices, and level 3 being based on their own estimates. For their marketable debt securities, they mostly fall into level 1 and level 2, meaning their value is fairly transparently linked to market conditions. They hold about $140 million in available for sale marketable debt securities. These are investments they can sell if needed. The breakdown shows corporate debt securities, government bonds, and mortgage-backed securities. The vast majority of these are in an unrealized gain position, which is positive, although the overall unrealized gain is pretty small compared to their total assets. This is a big one, their debt. As of May 2026, their long-term debt is about $9 billion. They have a variety of senior notes with different interest rates, ranging from 1.65% up to 6.55%. They also have significant commercial paper borrowings, which are short-term loans, totaling another $1.4 billion. The company has a revolving credit facility with a borrowing capacity of $2.25 billion, which they can increase to $3.25 billion. Importantly, as of May 9, 2026, they had no outstanding borrowings under this facility, but they did have $1.7 million in outstanding letters of credit. This shows they have considerable financial flexibility. The report mentions that their debt is trading at a fair value slightly higher than its carrying value, which is a good sign, indicating market confidence in their ability to repay. This is where AutoZone really shines in terms of returning capital to shareholders. Since 1998, they have repurchased a staggering $39.8 billion worth of their own stock. In just the first 9 months of fiscal 2026, they bought back $1.3 billion in shares. As of May 2026, they still had $800 million authorized for future repurchases. This aggressive buyback strategy often boosts earnings per share by reducing the number of outstanding shares. The report also details the retirement of treasury stock, which effectively cancels those shares and impacts retained deficit and paid in capital. AutoZone operates as a single reportable segment, focusing on automotive parts and accessories across the Americas. They have 7,856 stores in total, with a significant presence in the US, Mexico, and Brazil. The chief operating decision maker, their CEO, reviews consolidated financial results and key expenses to make decisions. This single segment structure simplifies analysis, indicating a unified business strategy. A notable event mentioned here is the invalidation of certain tariffs by the US Supreme Court. AutoZone has filed for refunds for the tariffs paid. While the outcome is uncertain, it signals a potential financial benefit if the refunds are approved. This is an interesting development that could impact their cost of goods sold in the future. And as with any financial filing, we have the independent auditor's report. Ernst & Young LLP states they have reviewed the condensed interim financial statements and are not aware of any material modifications needed. They also confirm that the balance sheet figure from their prior annual audit is consistent with the interim statements. This report gives us a level of assurance that the numbers are presented in accordance with accounting standards. Now, let's dive into management's discussion and analysis, or MDDA. This is where the company's leadership explains the numbers and their outlook. They highlight an 8.4% increase in net sales, driven by same-store sales growth and new store openings, domestic commercial sales, which are sales to repair shops and businesses, grew by a strong 10.4%. This suggests their business-to-business segment is performing very well. The failure and maintenance-related categories still make up the bulk of their sales mix, which is typical for an auto parts retailer, they believe long. Term trends like miles driven and the average age of vehicles on the road are key indicators of their market growth, with miles driven up slightly and the average age of cars on the road reaching a high of 12.8 years. This environment is generally favorable for auto parts sales. Looking at the short-term results, AutoZone saw a solid 8.4% sales increase. Same-store sales were up 3.9% on a constant currency basis, which means this growth isn't just due to fluctuations in foreign exchange rates. This is a healthy sign of organic growth. The gross margin dipped slightly, and again, the LIFO impact is called out. This is important because in a rising price environment, companies with LIFO inventory accounting might report lower profits than companies using FIFO. Or first in, first out, it is a way to potentially defer taxes but can make comparisons trickier. Operating expenses as a percentage of sales actually decreased. which is a positive sign of efficiency. Net income and diluted earnings per share both increased, which is always good news for shareholders. Over the longer 9-month period, net sales grew by 8.3%. Same-store sales also showed consistent growth. However, the gross profit margin saw a more noticeable decrease over this longer period, down to 51.9% from 53.2%. The report attributes this to a 142 basis point unfavorable LIFO impact. This suggests that rising inventory costs are having a more pronounced effect on their profitability over the year. Operating expenses as a percentage of sales slightly increased this period, which they attribute to investments in growth initiatives. Net income actually decreased slightly for this period, and diluted earnings per share showed modest growth. This indicates that while sales are up, the increased costs and the LIFO impact are weighing on their bottom line over the longer term. In terms of liquidity, AutoZone appears to be in a strong position. They have $253.7 million in cash and cash equivalents and $2.2 billion in undrawn capacity on their revolving credit line. They believe they have enough liquidity for operations, investments, and share repurchases. They are also actively investing in growth initiatives, particularly new stores, and expanding their hub and mega hub concepts. Now let's look at some of the non-GAAP measures they use, like adjusted after-tax return on invested capital, or ROIC. For the trailing 4 quarters, their ROIC was 36.3%, down from 43.5% in the previous year. This metric shows how effectively they are using their capital to generate profits. The decrease suggests that while still very high, their return on invested capital has slightly declined, which could be related to the increased investments in growth or potentially inventory costs. Their adjusted debt to EBITDA ratio, which measures their leverage, remains stable at 2.5. This ratio indicates the company's ability to cover its debt obligations with its earnings before interest, taxes, depreciation, amortization, rent, and share-based compensation. A stable ratio means their debt levels are in line with their earnings capacity, which is generally a good sign for financial health. When it comes to market risks, AutoZone notes changes in commercial paper borrowings and debt repayments. They highlight that a 1 percentage point increase in interest rates could unfavorably impact their earnings by about $13.6 million annually. This is a concrete number that shows the sensitivity of their business to interest rate fluctuations. The company reports that their disclosure controls and procedures are effective. They are also in the process of implementing a new enterprise resource planning, or ERP system, which is designed to improve their financial record keeping and transaction processing. Introducing a new system always has risks, but they believe it will enhance these controls over time. Here we see the numbers for their share repurchases during the quarter. They bought back over 163,000 shares for an average price of nearly $3,582 per share. This continued aggressive buyback strategy is a major theme for AutoZone, aimed at boosting shareholder value. Finally, the exhibits are mostly legal and corporate governance documents, including certifications from their principal executive and financial officers, confirming the accuracy of the report. So, what is my take on all of this? AutoZone is clearly a robust company with strong sales growth and a dominant market position. Their expansion into new stores and commercial sales channels is paying off. The biggest financial story here is their ongoing commitment to returning capital to shareholders through massive share buybacks, which has significantly benefited their earnings per share and stock performance historically. However, the slight dip in gross margin, particularly over the longer period driven by that LIFO accounting and rising inventory costs, is something to watch. While they are managing it and have a favorable debt to EBITDA ratio, it is a concern that could impact profitability if inflation continues unabated. They are making significant investments in growth, which is positive for the long term but might put pressure on margins in the short term. The risk I am watching is how effectively they can manage rising inventory costs and the impact of LIFO accounting on their reported profits without hindering their expansion efforts. And the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Check out the Discord in the description.